I need some traction. You need some traction.
Hey everyone, Lloyd Lobo here, co-founder at Boast AI and TractionConf. Today's webinar is brought to you by Boast AI Launch Academy in partnership with BCF Ventures, Lazaridis Institute, and Founder Institute. Super stoked for today's session on Blitzscaling. Everyone wants to know how to do it, and who can you find that's better than the gentleman who wrote the book himself, Chris Ye. Excited to have you with us, and you co-authored this with Reed, and basically talks about how to take companies from 0 to billion as fast as possible, build world-class companies like Amazon, Alibaba, Airbnb, and whatnot. You're a writer, investor, entrepreneur, and you've had a ringside seat in some of the top scale-ups and startups of the world, and you've been helping founders and VCs from day one all the way to a billion. I'd love to learn more about your story before we go into things. How did you get into all of this?
Well, it's a very simple story. And by the way, this is a very apt day for doing this talk because today is the day that Airbnb is going public. And I haven't checked the stock price recently, but I believe it looks like there is a chance that by the end of this day, Airbnb will be worth over $100 billion in market capitalization. So pretty remarkable story for a company that was started by 3 guys who were financing it on their credit cards. So tremendous, tremendous accomplishment and a great proof of the power of blitzscaling. So the way I got involved in all this is I was fortunate enough to do my undergrad at Stanford University back in the early 1990s. And when I got to campus, that was the first time, in fact, that I got an email address, right? I was in the first class at Stanford that was allowed to have their own email addresses, like universally. And as I was getting towards the end of my time at Stanford, there was this stuff coming out with Gopher and Waze and all these things. This internet thing was huge. It was going to be beyond just email. It was going to be other stuff as well. And so instead of doing what I had planned to do, which was to either go to graduate school in creative writing and become a literary author or professor, or to become a designer at IDEO, which is my other major, product design engineering. David Kelly was my advisor. I ended up saying, you know what, I'm going to take a chance on this internet thing because I think it's going to be big. And I ended up going into the internet industry, first with D.E. Shaw, which is the company that Jeff Bezos worked for before he started Amazon. And then out here in Silicon Valley as a founder and entrepreneur and operator and later investor and advisor. So by the time Reed and I were thinking about writing this book, I'd already spent 20 years in the tech industry, about the same amount of time as Reed had. And we were looking at the remarkable pattern where a lot of companies, especially here in Silicon Valley, were growing faster than any other companies in history, where there was just this tremendous increase in the number of unicorns. And the question was why that was. And that's what ended up leading us to write the book Blitzscaling. We were trying to answer a question that we were pondering ourselves. And oftentimes the best way to do that is to go ahead and do the research and write a book.
Definitely, definitely. And today is also a good day for me and us at Boast AI and yourself as well. You're closing a big fund, Blitzscaling Ventures. Why don't you tell us more about that and how that's going to work?
Absolutely. So, as an author, I'm also kind of a founder and entrepreneur as well. And there are many things I do. One is to go and talk at wonderful conferences and events like this. But the other is, well, what is the best way to really leverage the power of blitzscaling beyond just collecting large checks from corporate clients and things like that? And the conclusion we reached was to use the power of blitzscaling to invest in the next Airbnb. Obviously, being able to invest in a company that goes on to be worth $100 billion on the day it goes public is a tremendous accomplishment. And so what we do with Blitzscaling Ventures is we use the principles of blitzscaling to identify the companies that have the greatest chances of becoming the next $100 billion winner. And then we use the power of the book and the reputation it confers to get into those deals. So I actually go directly to the CEOs of these companies and say, hey, listen, I'm Chris Ye, the co-author of Blitzscaling. You've probably read it a couple of times. And I know what you're about to go through. We've looked at your company and we believe that you could be one of the next $100 billion winners, one of the next Amazons, Alibabas, Airbnbs. And we would like to invest in you. And if you let us put your money in, we will help you figure out how to refine your business model to be as blitz scalable as possible and help you navigate the various obstacles and things that are come up along the way as you try to blitz scale. And since all we're asking you to do is to invest $1 to $2 million in their next round, it's usually a pretty easy thing for them to say yes to. And that allows us to build an incredible portfolio. So we start with 1,000 companies a year that are being invested in by the top venture capital firms. And we eventually filter it down to about 20 to 30 that we think are truly blitz scalable and have the chance to be gigantic winners. And then we pick the best 4 or 5 out of those. And those are the ones we invest in.
Awesome. And today also big news for us at Boast AI. We closed a massive Series A, 30 million Canadian dollars, 23 million USD. We're on TechCrunch, VentureBeat, and all over the news. Globally, over 200 billion is given in R&D incentives to fund businesses, but it's manual, it's broken, it's cumbersome, and we're using AI to automate that so companies can get more money faster for less time and risk. Effectively, our vision is to be the de facto way how companies fund their innovation and their R&D, and this is a step in the journey. We've bootstrapped the company so far, and it's been hard, but the community, the Traction community, has been a huge support along the way, and bringing speakers and giving value into the community has been huge for our own learning as bootstrappers. But Chris, I'm not going to hold you up much longer. Some great news here today, and you have a fantastic set of slides. So without further ado, take it away, Chris.
Fantastic. And what I love about this community that you've built here is I can see just how incredibly interactive everyone is. Everyone's so engaged. Let's begin with the following question, because we have so many entrepreneurs in the audience. How interested would you be in getting your company to grow 50x in terms of employees, 94x in terms of customers, and 322x in terms of revenues over the next 3 years? Probably sound, yes, very interested, John says. Sign me up, says James. Absolutely. But most entrepreneurs are very excited about this. Now, I didn't pick these numbers at random. These are numbers that are from a specific company that actually grew at this rate. And the first piece of interactivity is going to be, I'd like to have you guess which company it is. Now, I'm going to give you 2 clues. The first clue is that this is a company that grew at this rate from 1996 to 1999. So this is a older company, not Airbnb, although that's a good guess because it would be very appropriate today. You'll see Airbnb later on. And the second is it's a company that you've already used right on the SPAC IPO lists. So I see a bunch of guesses: Yahoo, Netscape, Google, Amazon, AOL, Amazon, and absolutely it is Amazon, 100%, as somebody said. So from 1996 to 1999, Amazon grew at this tremendous rate. And in 1996, I like to call it a small online bookstore, 5.1 million in sales, kind of like the sales you get at an old-fashioned Barnes and Noble or even Burs when those existed. But then just 3 years later, it was the world's leading e-commerce company, 1.64 billion in sales. And the important part is not just that they grew incredibly fast during those 3 years, but that growth allowed Amazon to become the enduring market leader. After all, Amazon is still by far and away the leading e-commerce company in the country, in the world. It's obviously competing with companies like Alibaba as well, but certainly given Jeff Bezos' status as the richest man in the world and Amazon's status as one of the most valuable trillion-dollar companies in the world, I would say that he's still maintaining his position of leadership. Pinduoduo as well. Yes, absolutely. Tremendous activity happening in China, which is why we call China the land of blitzscaling. But the question becomes, all right, this is great. I want to have this. I want to have the $1 billion or $100 billion or $1 trillion company. I want to have the cool sunglasses and have the chance to work out and build up muscles like Jeff Bezos, because you'll see later on that Jeff Bezos didn't always look like this. But how do we do this? How does this actually work? Well, the book, of course, that I'm talking about today is Blitzscaling, which I co-authored with my old friend and collaborator, Reid Hoffman. Now, most of you probably know Reed, but of course, Reed is responsible for $1 trillion in market cap and counting. Actually, this slide was accurate a couple of days ago, but now I need to update it because you have PayPal, Facebook, LinkedIn, Airbnb. I need to scratch out that 20 billion and turn it into 100 billion. So Reed, of course, was the founding board member and an executive at PayPal. He was the first outside investor in Facebook. He, of course, founded LinkedIn, and he was the Series A lead investor in Airbnb. So incredible track record. And what we tried to do with the book Blitzscaling is to say, let's take all of Reed's experiences and all the things he's learned along the way and put them into a framework so that other people could understand how you could end up being somebody who is responsible for $300 billion companies. And the answer, of course, is blitzscaling. Now, I'll let you in on a little secret for any of you who are thinking about being authors someday. One of the things that Reed and I learned about being an author is it's really important to come up with a new word. Something like lean startup, for example, a combination of words that's never been used before. And the reason is when you do that, then you can go ahead and brand it, copyright it, and make a lot more money. Our previous book, The Alliance, was a New York Times bestseller, but The Alliance is not something that is unique to us. And so being able to make up our own word really, really helped us quite a bit. And it allows me to do things like put a Google alert on so I can see whenever people mention the term. It's very gratifying to see how broadly it's been adopted. I always tell people, you know, the best sign of your book's success is when people start using your terms wrong, because that means it's so important that even people like Christy, who haven't read the book, feel compelled to use it. Don't worry, Christy, you will get a chance to read the book. I'm sure it's available in bookstores everywhere, and you're getting a good sense of what's going on just from this presentation. And yes, Ajit mentions Amazon is unique because it wrote internet penetration versus the standard network effects. So Amazon does have some network effects, but their core original e-commerce business did not have network effects, and they actually engineered a number of network effects into the business model. So maybe in the Q&A session, we'll talk more about Amazon, which I think is one of the companies that's done the best job of managing blitzscale. It's truly remarkable what Jeff Bezos has done and truly to be admired. So back to blitzscaling. So we came up with the word blitzscaling to refer to the pursuit of rapid growth by prioritizing speed over efficiency in the face of uncertainty. Now, the first part of it is not very controversial. If you say pursuit of rapid growth, well, we just talked about that earlier. I've never had an audience, and I've spoken on almost every continent. I still need to get to Australia, and I'm not sure about that Antarctica speaking engagement. But other than that, I've been to every continent speaking about blitzscaling. And I've yet to have an audience who said, you know what? We would really like to learn how our company can stagnate until it dies. Really, that is just something that does not make a lot of sense. So pursuing rapid growth, absolutely, everyone gets that. But prioritizing speed over efficiency in the face of uncertainty, that sounds risky. That sounds like it's dangerous. That sounds like it's uncomfortable. And in fact, it is all of those things. But there are times when taking on that additional risk is less risky than pursuing what would seem to be the cautious path. And let me give you an example. We're going to do a quick case study, and we'll answer some of the questions I see about things like eBay as well, because that will help address what's going on there. So think back to 2002. It's almost 20 years ago, and the world was very different, right? We were not at a period of time where the stock markets were reaching all-time highs. In fact, the stock market had reached a high. NASDAQ had been at 5,000, but now it had plummeted down to around 1,200. So a remarkable decline in the NASDAQ. It's what we call the dot bomb era, after the dot-com era went away. And at the time, Google was very different than it is today. It was a small, privately held company and had about $15 million in the bank. And it had done $19 million of revenue in 2001. So that's the backdrop for this story. It's 2002. And in 2002, Google reached a deal with America Online, which at the time was the most powerful company on the internet. They had bought Time Warner. They were the biggest media company in the world. This was a gigantic, enormous success story. And Google did a deal with AOL where Google would power AOL's search engine. So instead of getting whatever results they were getting before, now they were getting results from Google. And Google is going to monetize that search traffic by putting little text ads next to the search results, what we all know today as AdWords. Now, this was in the very beginning. Google, again, very small company, $19 million in revenues. So let me explain the terms of the deal. The terms of the deal were that AOL would get 85% of the revenue. So Google would take on all the costs, all the implementation, and keep 15% of the revenue for themselves. 85% would go to AOL. And that's pretty generous because a lot of advertising networks were keeping 25, 30, 35, even 40% of the revenues. 15% is a very small take, relatively speaking. And the other thing that Google did is they actually guaranteed AOL minimum payments of $150 million a year. Now, I want you to remember that Google had 15 million in the bank and they just guaranteed 150 million a year in cash payments. And they made a 3-year commitment. So it was a $500 million commitment for a company with $15 million in the bank and 19 million a year in revenue. So you can imagine, those of you who have boards of directors, what it would be like when you went to your board and said, let me tell you, we've got this incredible deal. And this incredible deal is such that we are going to go ahead and commit $500 million to one of the biggest companies in the world. And we're going to go ahead and do this, even though we only have $15 million in the bank. Now, so for those of you who have boards of directors, what do you think their reaction would be? What would your board tell you if you went to them and said, I need you to sign off on a deal where we are guaranteeing payments of $500 million? What would people say? Yeah, out to lunch. Are you crazy? They'd laugh. Absolutely. Right? It seems nuts. Hell no. Yeah, exactly. But you're fired. Yes, exactly. But the thing is, if you think about it, call a doctor. Yeah, get the men in white coats. Take this guy away. Take this gal away. Where's the revenue coming from? All right. So we all know that this story doesn't end with Google going bankrupt. In fact, it ends with Google triumphant. And this deal truly helped make Google what it is today. So the year before, you remember, revenues were $19 million. The year after this deal, revenues were $347 million. So that was a nearly 20-fold increase. I mean, it's truly a remarkable increase. And this put Google on track to be the company it is today. Now, why was it that this worked out the way it did? Why did Google think that this was going to work? Well, there are a couple things. The first is that Google was actually doing things a little differently than its competitors. Its competitors, like Overture, had a system where people would bid on advertising slots. And whoever bid the most, those ads would show up. And then when somebody clicked on them, they get paid. Google said, you know what? We are really good at figuring out what's relevant by looking at what people click on, by looking at links and things like that. We can figure out relevance. Let's apply this relevance to advertising as well. And so what Google did is they said, we're not going to show the highest bidder. We're going to figure out which ads are most relevant and most clicked on. We're going to favor those ads, because if we favor the most relevant ads, we can actually make more money and we can optimize our revenues better than just by looking at the bids. And because this is an AI-based algorithm, because it's based on data and training data, getting a whole bunch of training data from AOL and all of their traffic allowed Google to dramatically improve their algorithms faster and faster, make it almost impossible for anyone else to be able to catch up. But there's another element to it. Exactly. The Google model has persisted. Apple pays Google to this day. Absolutely. And again, people sometimes call Google a one-trick pony because almost all of its revenue comes from this advertising. The answer is it's okay to be a one-trick pony if your trick is this good, because it is truly remarkable. By the way, Google demonstrates that you don't have to raise a colossal amount of money to Blitzscale. Google only raised a single round of venture capital financing, $25 million from Sequoia and Kleiner Perkins. That was their Series A, and they never raised any more money after that. They were able to fund all this growth out of the revenues and cash flows from operations. So it is possible, if you strike a gusher of money, that you'll be able to do this. Now, the other element of it, as I mentioned, is that Google was actually looking ahead, or at least perhaps was looking ahead. One of the things about AdWords is it then led Google into the realm of AdSense, in which they help other publishers monetize. And even today, if you go around on the internet, oftentimes you'll find ads being served from Google on other websites. And in that sense, it really is also a bit of a two-sided marketplace. So you have advertisers and you have publishers on the two sides of the marketplace. The advertisers want to go where there's the most traffic. The publishers want to go where they can make the most money. And Google, in order to attract advertisers, needed a bunch of inventory. And AOL was one of the few places where they could get it. Google was not going to be able to do a deal with Yahoo for this. That's their whole business. They owned Overture. They weren't going to be able to do a deal with Microsoft. Pretty much all the big players were locked up except AOL. So Google had to win the AOL deal at practically any cost. But by winning it, they got this tremendous inflow of traffic, which meant they were now much more attractive to the advertisers who want a place to go where they can get lots of volume. And as they become more attractive to the advertisers, more and more advertisers flock to the platform, making it ever more attractive to the publishers who want to go where the advertisers are. So this two-sided marketplace creates a network effect where the Google AdSense and AdWords networks became more and more valuable. And again, impossible for anyone to catch up with. And today, Google remains the leader in online advertising. Google and Facebook dominate online advertising. Everyone else out there is actually shrinking in terms of their market share. Google and Apple are growing, Google and Facebook are growing their market share. And it's because of these powerful network effects and the fact that they have won a winner-take-most market. So that is great, right? I can blitzscale and I can become a $100 billion company like Airbnb, or I can become a $1 trillion company like Google. Wow, that sounds fantastic. But should everyone blitzscale? And Bonnie points out, hey, Theranos is a scary example of moving to fast and health. So the interesting thing about Theranos, which we studied in great detail, and here's a secret: you can go onto YouTube and you can see me actually interview Elizabeth Holmes for, I think, an hour and a half when she visited our class at Stanford. Fascinating story there. I'm happy to tell later on in the Q&A time if you guys want to hear it. But the thing about Theranos is not that they were blitzscaling, right? It's fine to blitzscale, to sacrifice some efficiency for the sake of speed. The issue with Theranos is they were actually fraudulent, right? The way they were fraudulent is Theranos was supposed to have technology that would allow them to take a single drop of blood and run blood tests on it, which is great. I mean, I'm sure many of you have had your blood drawn for testing, and it's really not fun, right? They stick a needle in your arm. It takes a whole technician. It slows things down. It'd be much faster if you could just have a pinprick test, because you even have devices like those people who have diabetes, they put their finger in, they get the one drop of blood, and that would be enough. Now, the product didn't work. As Dallas put it, the product didn't work. As Chris put it, nobody asked to see under the hood. They just trusted her. Interesting story on that as well. So we're taking a digression here on Theranos. I hope you guys don't mind. So the product never worked. And that's in fact the case, right? It was supposed to work on a single drop of blood, and they couldn't get it to work. And what they did instead, which is the criminal part, is they just got a bunch of conventional blood testing machines, and they would take the blood drop, they would dilute that blood drop with water, they would run it through the testing machine, and then would multiply the results based on the level of dilution to get a result. Now, that's not the way those things are designed to do. I mean, my gosh, right? Just think about the level of error that creeps in when you take a drop of blood, dilute it down by a factor of 100, run it through a test, and then multiply those results by 100. We would never accept this anywhere. But this is exactly what Theranos was doing. And again, nobody asked to see under the hood. Now, why was this? Now, this is an interesting point about Theranos. The interesting thing about Theranos is Theranos had very little Silicon Valley backing. True story. So if you go through and you look at Theranos, you say, how many venture capitalists were actually invested in Theranos? There's only one, and that is Tim Draper. Now, Tim Draper is a phenomenal venture capitalist who has made colossal amounts of money and is a legend in the field. But he was not objective when it came to Theranos. And I've spoken with Tim since then. We were on a trip to Mexico together, and he was still talking about Elizabeth. This was a number of years ago. And the thing is that Elizabeth Holmes was a family friend of Tim Draper. She was almost a surrogate daughter. She was friends with his kids. And so, he wasn't objective when it came to this. He saw Elizabeth and said, she's awesome. She's fantastic. This is going to work. And then the rest of the folks, the money they got was not from Silicon Valley venture capitalists. They're from other sources. And they had all these board members like George Shultz, enormous, incredible figure in American history, former Secretary of State, brilliant thinker, not a technology investor. So this was a terrible, terrible situation. Now, again, the problem was that Elizabeth Holmes and her co-founder, who, by the way, were secretly dating as well, again, not something that you're supposed to do, lies upon lies upon lies, they decided that, we're going to fake it till we make it. And there's a long tradition of this. It's no coincidence that Larry Ellison was also a supporter of Theranos. Larry Ellison is the patron saint of faking it till you make it, right? He's the reason why we have the term called vaporware, because at Oracle, he would just say, if somebody came up with a great product, he would just claim Oracle was doing it, even though they hadn't started working on it at all yet. And so as a result of this, she was going out there and she was creating fraudulent information. She was deceptive about what they were doing. The entire company was doing this. And that's why Theranos failed. Now, what this obscures is Theranos actually did some pretty interesting things. Probably the most important innovation Theranos had was not the technology, although if they had been able to do that, of course, that would have been important. It's the regulatory innovation. They actually worked with people like the state of Arizona, and they were able to get permission to do in clinic blood testing. So you could go into a Walgreens in Arizona and just get blood tests. You didn't have to doctor order them. That's exactly the way that things should go, right? We shouldn't have to go see a doctor in order to get our blood test. If I want to know what my cholesterol is, why can't I just go into a store and say, hey, just give me a test? And of course, the technology with the pinprick single drop of blood would be important because then it could be automated as opposed to being done manually by phlebotomists. So there was actual innovation. The sad thing is the cratering and destruction of Theranos because of this fraud has prevented anyone else from really going into this area. So this area has sort of been poisoned a bit. So in some sense, Theranos didn't just harm its investors, didn't just harm the people who relied on its information, which blood tests were wildly inaccurate, but it also harmed humanity as a whole because it caused us to distrust this kind of innovation, which would be really helpful if it actually happened. And Holly asks if there's going to be a documentary at Theranos. There are several of them. And in addition, I think that obviously because of the pandemic, the production may be on hold, but they're planning on actually doing an entire theatrical release starring Jennifer Lawrence as Elizabeth Holmes. So look forward to that coming to theaters near you sometime in the near future. In addition to everything else, the bad behavior that Theranos engaged in. Here we have fraud, and then what they would do is they would attack any critics. I mean, one of the really sad things is that the chief scientist of Theranos actually committed suicide. And it's because he could not take the strain. He was being asked to do things that were immoral. He was being put under tremendous pressure. And he ended up killing himself, which is a great human tragedy as well. So if the question is, should everyone blitzscale? The answer, of course, is no. Of course, the answer is, you can't. We're never going to blitzscale something that's fraudulent. But there can be something that's not completely fraudulent, and it still doesn't necessarily make sense to blitzscale. And so the example I'm going to use is one that all of you are familiar with, which is Wework. So Wework is one of those companies where people are like, yeah, weren't they blitzscaling? And we're like, yes, they did attempt to blitzscale. You remember the definition: prioritize speed over efficiency. Did they do that? Absolutely. They were wildly inefficient. They were growing really fast. In fact, they were one of the fastest growing companies of their size. For a big company with over $1 billion in revenues to double in size is truly remarkable. And that's why people kept piling money in, SoftBank especially. And they ended up raising over $15 billion. But the issue is that WeWork really did not make a lot of sense. If you think about it, look at this graph. The red is the loss from operations, not the cost of operations, mind you, the loss from operations. So even as WeWork was expanding and growing at this tremendous rate, its costs were growing almost as fast, and it was just wildly in the red. Now, the thing is, it's obvious from looking at it and from seeing what happened with WeWork afterwards that it wasn't appropriate to blitzscale. But the question is why, right? We don't want it just to be like the classic, well, I know it when I see it. And so that's what Blitzscaling, the book, is all about, helping people understand what are the things involved that tell you whether or not to blitzscale. I see a couple of other comments along the way, by the way, from Bonnie. It's time to blitzscale fixing the planet. Absolutely. It's really important. Blitzscaling is an incredibly powerful tool that could be applied to a lot of things, including things that are going to produce social good. And by the way, one of the people who's doing a lot in this area, my friend Tom Chi, has a venture fund that is specifically investing in businesses that are going to solve the world's greatest problems. And so really just a tremendous guy, one of the early people at Google X, also at Yahoo. And thank goodness we have people like that working on these kinds of issues. And Daniel notes, WeWork, same as Nicola, scammers, I could see it from a plane. Yes. What does that graph look like at Amazon? So what the graph looks like at Amazon is very different. What Amazon would show you is losses from operations that were steady and maybe even growing at various times, but they actually showed ups and downs. So with Amazon, they actually were able to turn profitable at various points in time when that was what Wall Street really wanted them. And then what they ended up doing is they ended up becoming profitable more and more less permanently. And that's because they built additional business lines like Amazon Web Services that have allowed them to just print money, which is a phenomenal business. We can talk about Bitcoin as well. Bitcoin is a fascinating story. I have my own biases, but again, the good news is we have plenty of time, so I don't have to rush through all these things, which is fantastic. And we'll talk about Uber as well, and a few things about Uber, a couple of non-public predictions about it. So we need a framework to actually evaluate why blitzscaling makes sense and when it makes sense. And that's the framework here. So in the book, we talk about the growth factors and growth limiters of blitzscaling. Since then, we've refined it a little bit further because in the book, all of them were just presented in order. We didn't say that some were more important than others. And what we've concluded is we actually have two of these key elements that are essential. The others need to be there, but two of the key elements are essential. And in the words of our patron saint, Ricky Bobby of Talladega Nights, if you ain't first, you're last. So the big question is, are you in a Ricky Bobby market? Is it a market where if you ain't first, you're last? Well, let's take a look at the key elements that need to be in place. The necessary elements need to be there. And if you blitzscale without these elements, you're probably not going to be very successful. And I'll give you a couple of examples. Big market. So with big market, you absolutely need a big market. The nuance here is it needs to be a big future market, right? It doesn't necessarily have to be huge today. It needs to be big in the future. Think about Airbnb as a market. Airbnb is like, well, what is our market? Our market is people who want to rent out airbeds in other people's apartments. Well, that's pretty small market. But it turns out that lets you expand into bigger markets. Well, what if you just rented out the entire room? What if you rented out the entire apartment? What if you allowed people to rent out any kind of space whatsoever? And so you have this massive growth of the market because you start off in one small area. Maybe you're just selling books and you slowly grow until you're selling every single thing in the world. So the market can absolutely expand over time. There are also times when the market expands because of your own action. So think about Uber. Uber is a company which people have been asking about. We'll talk more about Uber at length in a couple of these. But with Uber, the thing about Uber is that its market originally was much smaller. So there's a very famous professor at NYU named Aswath Damodaran. He is known as the Dean of Valuation, which means he's the guy that everyone on Wall Street looks to and says, well, how much should this company be worth? And he wrote a report on Uber back in the days, about a decade ago, where he concluded that Uber could never be worth more than $1 billion. And of course, he's off by considerable amount on that calculation. Well, how did he do his calculation? Well, he looked at the fact that there was $100 billion market for taxi cab rides. And he decided that Uber could capture about 10% of that market. And then he said, well, based on that and based on assuming a take rate, here's what they could do in terms of discounted cash flow, and therefore it's worth about $1 billion. Now, who can tell me what's wrong with that analysis? Because I can assure you the math that he did was 100% correct. So what was wrong about Professor Damodaran's analysis? Did you hear the one about the farmer? He didn't want to own all the land, just the land next to his. That's from Marty. Yeah, no, that's true. It's all about adjacent markets and market expansion. But can tell me, they distorted the market. So Uber market expanding over taxis. That's from Locke. Yes. And Uber created a market from Ed. Yes. So this is the thing, right? You all can remember taking taxis. And before the pandemic, obviously the pandemic has really taken things down quite a bit. But before the pandemic, how much were you using ride hailing versus how much you were using taxis 10 years earlier? And the answer is a lot more, right? When I used taxi cabs, the only time I used taxi cabs were to get to the airport or get back from the airport, or when I was in New York City, because New York City, there's no other way to get around. And so as a result, Uber actually expanded the market. Now, all of a sudden, now you can call a car wherever you are. You can get it. The prices are lower. It changes. You actually think about a lot more ways to do it. Now, there's a couple of things that are coming into the chat room I want to comment on. Ron mentions Uber had no competition because they started by breaking local laws. No one else was bold enough. Yes, this is a fascinating story. One of the things is Travis Kalanick, who is the founder of Uber, ran into problems and was eventually ejected from the company. And he made a lot of mistakes. Some of them were ethical mistakes. Some of them were management mistakes. Suffice to say, he's one of the more flawed founders and CEOs you'll ever see. But many people will say Uber could not have done what it did without Travis in charge, because he was the one who was willing to break the laws. He was the one who was willing to compete and do all these various things. And the thing about breaking the laws is, the question becomes, you have to evaluate to what extent does this law make sense? Back in the early days of PayPal, one of the issues that PayPal was dealing with is what they were doing banking. Were they breaking regulations? And the reason why they were willing to take the risks that they did is they felt that ultimately what we're trying to do is we're trying to do things in a way that are better for society as a whole. The restrictions that exist on banking, the restrictions on who is allowed to send money, those are bad restrictions. All they do is they serve to entrench monopolies that are not doing very well. So as a result, you can ask yourself, well, should the taxi medallion monopoly exist? Is that a good one? And it's fascinating, by the way, to look at the difference between Airbnb and Uber. By the way, Airbnb, because of this IPO, will finally be more valuable than Uber, something which I'm not surprised at all. But the difference between Airbnb and Uber is that Airbnb, while its core business model also seemed like it was going against certain regulations, hotels were like, well, how come they're not collecting a hotel tax? That's unfair competition. What Airbnb said was, you're right. Let's work with the municipalities to collect the hotel taxes. And as a result of that, that wasn't the fact that they were dodging occupancy taxes that allowed Airbnb to be successful. It's that they had a fundamentally different model, offering a different experience that people wanted, that they wanted over and above the experience they had of being in a hotel. So excellent questions and thought. Kieran mentioned society's laws will always be behind since we are innovating faster than laws can be written. If there aren't the users and the need to change the old laws will remain. Absolutely. As a side note, a great place to look at to understand this is there is a fantastic book called Ruling the Waves. It's from an old professor of mine, Deborah Spar, or rather a professor who I got to know a long time ago. I'm not sure if she wants me to call her old. A very famous professor at Harvard Business School, and later the president of Barnard College. And what Deb Spar wrote about is, if you think about what happens with the law, there are three different approaches. You can follow the law, you can break the law, or you can change the law. And all of them can work. But in general, the last one, the one where you actually change the law, is the one that tends to produce the greatest returns, because you are actually reshaping the environment in your image. And yes, the hand of God. William mentions Maradona's handball, the hand of God. Yes, that is a classic example of a winner-take-all situation where Maradona, let's put it bluntly, cheated. And yet it was one of the most important things that happened in the course of sports. Somebody mentions Lessig's pathetic dot theory on forces and code is an awesome resource as well. William asked the title of the book. The title of the book is Ruling the Waves by Deborah Spar, S-P-A-R, Deborah Spar, and the book is Ruling the Waves. It came out around the turn of the century. Oh, great. Thank you so much. Somebody put the link to it in the chat room. So getting back to the big market, the issue is you got to predict the future. You got to understand how big the market is going to be. And it's really the market in 5 years that matters, not the market today. Product market fit. You guys are probably familiar with product market fit. But the thing about product market fit is it is necessary but insufficient. So you can have product market fit, but you may still not succeed. But if you lack product market fit, you'll never have sustained success. So a great example of this is Groupon. Groupon is one of the fastest growing companies of all time at one point by revenue. And it had a lot of these great elements. It's got a big market. It's got high gross margins. It's got all this stuff, but it failed. And why did it fail? It failed because its product was not very good. So anyone out there who has used Groupon before, I certainly have. Let me ask you, have you used Groupon in the past 6 months? Again, the pandemic's probably hurting that, but even so, I'm willing to bet that very few of you have used Groupon in the past 6 months, but I bet that almost all of you have used it or a competing product at some point in time. Now, why do we no longer use them? It's because they're too much of a hassle. They're not actually good for the customer, and they're not actually good for the merchants either, because the merchants are suffering from a situation where the only people who show up with Groupons are cheap bastards who are never going to come back again. Alan asks about Honey. So Honey is a different story, right? The key to Honey is that it does not interfere with your standard flow, except in a way which you're happy to accept. So with Honey, with Groupon, you'd have to buy Groupon in advance, and you'd have to go ahead and then display it to the merchant at the time, and you wouldn't sure if it was going to work or not, and there was going to be hassle. With Honey, all you have to do is it says, hey, we think we could save you money. Should I try? You click yes, it does it, and boom, part of the time you save money. My wife is a big user of Honey, by the way, and of course the company was acquired for over $1 billion, so it's a happy ending for the entrepreneur as well. So product market fit is absolutely essential. Now, sometimes you may blitzscale before you have product market fit. It's risky, but you only do it because the competition might beat you to the punch and get to product market fit and scale before you. So you've got to get both of those. High gross margins. High gross margins are necessary because ultimately your margins determine how much money you have available to fund your growth. And the gross margins are also going to really have a huge impact on how well people value your company. People are valuing Airbnb very highly because it has these high gross margins. Mandar says your points on Groupon are very valid. As past merchant and feedback from other merchants, we did see the Groupon decline coming. Absolutely. Return on invested capital greater than weighted access cost of capital. Absolutely. I love it. This is a really intelligent, really experienced group. 6.2 billion mistake by not taking the merger. Actually, even bigger. Mandar notes that Groupon did not take a $6.2 billion merger offer from Google or acquisition offer from Google, but it's worse because Google stock has split multiple times since then. So it's probably more of a $50 or $60 billion mistake. Think about that. I bet that the founders think about it all the time. Poor Andrew Mason. All right. So what is good gross margin as baseline? Excellent. Let's talk to gross margins. So with gross margins, What we are typically looking for is gross margins above 50%. That's what's sort of good. And the way I think about it is I like to put everything into what I call software equivalent revenue. So in the software business, you essentially have 100% gross margin because you have a product, you sell it, and you still have the product. So you just keep selling to other people. SaaS, there's a slight reduction in gross margins because you're paying for operations. That's considered part of cost of goods sold, but it's still extremely high. And most of these companies that we talk about have gross margins in the 80 to 90% figure. Now, if you have gross margins that are below that, you can still make it work. If you think about it, a gross margin of 50% is half as good as a gross margin of 100%, but it's still not bad. But if you have a grocery store with 10% gross margins, gosh, it becomes really, really hard to actually make it worthwhile, though it could be possible. But again, if you can help it, look for gross margins above 50%, shoot for gross margins in the 80% plus range if you can. And Daniel mentions, of course, you attract smart people. Oh, that's about the audience. Well, thank you, Daniel. Appreciate your showing up. Daniel has attended some of my events in the past as well, so I really appreciate it. And thank you, Salima. So then operational scalability and organizational scalability. The thing about operational organizational scalability is you need the ability to grow. If your company has hit this great product market fit, there's high gross margins, you have this enormous market, maybe you're getting this virality, you're explosively growing, all of a sudden, if you can't satisfy that demand, if you can't achieve the growth, somebody else can come in and take it from you. A classic example of this is Friendster, the first major mainstream social network, which ultimately failed because of operational scalability issues. The technical decisions they made in terms of building their product meant that their web pages would load very slowly once they got to scale. It was taking a minute or so in order to actually see the pages to load. And of course, people weren't going to continue using it. They started going to another service instead called MySpace, which pages loaded faster. And MySpace in turn was displaced by Facebook. Because MySpace had these, wasn't really social network oriented, it was more oriented towards like sort of producing a branded page on the internet, whereas Facebook was really firmly about that, the news feed. That was the big innovation that Facebook made. Again, this is a special treat for me because I usually don't have this much time. So you guys are getting more details than almost any audience ever gets. And that's because you guys were willing to invest the time. And so I want to reward that investment of time. Karan mentions Airbnb takes a service fee of about 15 to 20%. Yes. So Airbnb has a take rate of 15 to 20%. By the way, there's a reason why that tends to be sort of the ideal take rate. If you have a take rate that's too high, let's say you're taking 40 or 50% of the transaction as a marketplace, it means that there's really heavy incentives for people to circumvent your marketplace, right? Why would you pay half your money? The person who is on the other end of it, the service provider is going to say, listen, let's just pay me under the table. Don't worry about Airbnb. So the service fee can't be too high. The take rate can't be too high or people will circumvent. And so 10 to 15%, 15 to 20%, 15% or so is sort of like the golden rule for take rates. But then the thing about that is that the revenues and the gross margin are based on the take rate, not based on total bookings. So total bookings or gross merchandise value, this stuff does not necessarily mean revenues and gross margins. So revenues and gross margin are just the things that are coming as a result of what you have from the take rate. So for Airbnb, even if they do $100 billion in bookings, they're only doing $15 to $20 billion in revenue, but they have really high margin on that $15 to $20 million in revenue. Bruno mentions this is top level information. I feel like billions are being generated by the minute on this call. I certainly hope so. And again, I really hope that you guys take this away. And all I ask is that someday when you're enormously successful, please do credit Blitzscaling for helping you do that. All right. So then let's talk about the essential elements, because we've been talking about these necessary elements. We really need to get to these essential elements. So the first is the winner take most market. Now this is essential, as you said. It's got to be a Ricky Bobby market. And a winner take most market usually happens because there are either network effects or a land grab. With a network effect, what that means is that each additional node on the network increases the value of the network to everyone else in the network. So if you sort of chart it in your mind, like let's say you have a typical product that doesn't have a network effect, then the size of the network increases like this, right? Linearly, you're adding people to the network. And then you look at the value to the individual member. Each individual member sort of has a stable value. And because an individual has a stable value, somebody else can come in as a competitor and come up above that, and then come in and say, you know what, I've got a better solution for you. And so it's not a situation where you have a lot of competitive moat. But when you have network effects, now all of a sudden, the value of the network to the individual is increasing, often at a linear rate. And so it becomes harder and harder for anyone to catch up. And then according to Metcalfe's law, as Ajit mentions, the rate of the total value of the network is increasing exponentially. Metcalfe's law states that the power of a network is related to the square of its size, or the exponential factor of its size. So that is a great pull. Metcalfe's law is absolutely in effect here, Ajit. So with network effects, you have a whole bunch of different network effects you see. We've talked about two-sided marketplaces. There's also platform network effects of something like an iOS or an Android or a Windows. There's also single-sided network effect. So something like a Facebook, where it's all about just the more people who are on Facebook, the more valuable it is to everyone else, because there's more people that you can communicate with. So there's a variety of different network effects. We talk about them in the book. There's also a firm called NFX run by Chris Michel, which has tons and tons of content on network effects. So I encourage you to go to these places to look for more information. There were a couple of questions I'll just handle before they run off the screen. David asks, would Peloton be considered in the Blitzscale group as well? Fitness market, product market fit. So the key is Peloton has a combination of moderate network effects and a significant land grab effect. The moderate network effects are that Peloton is obviously about taking classes with other people, right? It's not a solo endeavor. So the fact that Peloton has the most classes, has the most instructors, has the most people participating in it is a moderate network effect. It is not an overwhelming network effect, because there are other people who can come out with their own sort of spinning classes and things like that. It doesn't mean that there's nobody else who can do it, but there are moderate network effects that help improve them and help them maintain a position of market leadership. But the land grab element is also really essential. How often are people going to buy a new Peloton or Peloton equivalent? Not that often. Once you grab that once you grab that space in their house where they've put the Peloton, you've pretty much got them. And the key with Peloton success is continue to develop the ability to retain over time, which is why the social element of the class is so important, which is why making sure that they want to do things like, hit a streak of number of sessions and so on and so forth. All that stuff really helps out. And so Peloton is an example of, it is not the canonical example of blitzscaling. It's not the highest level of network effects like an Airbnb, but there absolutely are things there. Daniel asked, where do you put SpaceX, Tesla, the solar galaxy of companies? How big will they grow if you have the time? Of these companies, I personally believe that the greatest long-term potential is in SpaceX, because the way I put it is, what's a bigger market than the rest of the universe? I mean, Earth is a pretty big place, but it's tiny in comparison to the rest of the universe. And you start thinking about, SpaceX having this massive advantage in terms of being the first one out there to really create the infrastructure of space. So I think there's just incredible possibilities there. In terms of Tesla and Solar City and all those things, with Tesla, there are some blitzscaling elements to it. There's no question that they were able to go ahead and really do a smart job on distribution. The fact that Tesla built out their own distribution network, for example, is a great reason, one of the hidden and underappreciated reasons why they're successful. But ultimately, of that galaxy of companies, I think that SpaceX has the greatest long-term potential. Kiran asks, is it important to build up both sides of the marketplace in balance? So yes, it is, although it's always important. You generally, and this is not just me, there's many people who study marketplaces will tell you this, you build up the supply side first. And the reason is the people who are bringing the money, the demand is the demand side. And so they need to come into the market and see options for them to spend. And so And people who are on the supply side usually are willing to be a part of multiple markets or to try things out because they just want to make more money. So build at the supply side first. Suraj asks, can enterprise software blitzscale? Absolutely. The key thing that prevents enterprise software from blitzscaling is typically the scalability of the distribution. When you have to sell it just with face-to-face sales or one-on-one sales, a traditional direct sales approach, it's a little slow. But if you can find ways to tap into existing networks or tap into virality for enterprise software, then you're really in business. And enterprise software has often has good network effects in terms of platform network effects, and often has great land grab effects because it gets integrated tightly into the way that the company works. Alexander asked about what insights do I have to share about ClassPass and its growth as a subscription platform. This is one where I feel like the network effects are moderate as opposed to very strong. So the thing is that ClassPass is basically demand aggregation, and they go out there and it's almost like a two-sided marketplace, but not quite, because they have to go out with the various local fitness studios, and local fitness studios say, I want to be a part of this. And so as a result, there are some moderate network effects. But the thing is, because it's really about people taking classes, and again, most people are going to take classes close to home, you don't have a true global gigantic network effect. You have a whole bunch of little network effects, micro network effects or local network effects. And those are not going to be quite as strong. It's a little easier for someone to come in and overturn you because they can focus their attention just on that particular market. There are so many different, oh, wow, I used to spin and ride with Metcalf's wife. That is fascinating. Wow, I'm not going to be able to answer. Oh my God, there's so many messages. You guys are a fantastic audience. I think this is wonderful, wonderful, wonderful stuff. So the winner take most market, I just described why you want to have network effects. The other would be a land grab, as I mentioned with enterprise software. I mean, once Microsoft Exchange gets in there, once Google Suite gets in there, how often do you change it? Not very. So if you grab 50% plus in the market, that can be a very powerful thing. You could have enduring market leadership as a result. And somebody asked a question about eBay earlier. So one of the interesting things about network effects is you can dominate a winner take most market, but then the question becomes, are you able to continue building on that market or not? So eBay dominates a market for sort of small one-to-one sales, traditional auction approach, and then also buy it now. It's a marketplace where people go to buy and sell things. And it is a thriving business, and it's been going for quite some time. And the power of the network effects are that, you notice it hasn't changed very much, barely changed at all. Craigslist, same thing. Craigslist has changed zero, and they're still enormously powerful in the marketplace. Craigslist still generates $1 billion a year in cash flow. eBay is still worth tens of billions of dollars. But the thing is that they have failed to expand their markets. So if you look around you, and look at all these companies that are successful like Airbnb. Airbnb is a $100 billion company. It's basically a much better implementation of the tiny section of Craigslist that was about renting places. And job sites, all these things, they're another tiny portion. Tinder, another tiny portion. People have done these infographics showing how basically Craigslist predicted all of these companies, but they didn't continue working at it. So you have to continue to reach out and add these new markets and blitzscale these new markets in order to stay on top. eBay is going to continue to be a valuable tens of billions of dollars company, but they're just no longer a leader because they've decided that they're just okay with being in this particular market, and they didn't expand into every other market around them. Whereas Amazon, in contrast, was not content with just saying we're going to be a retailer. They have Amazon Marketplace, they have Amazon Web Services, they do all these other things as well. So then there's the issue of scalable distribution. So the goal of blitzscaling is to win a winner take most market, a Ricky Bobby market. And to get there, you need to cross the finish line first. The finish line is when you reach a critical level of scale where sustainable competitive advantages kick in because of the network effects or because of the land grab. And so scalable distribution determines how quickly you can get to scale and how much money it's going to take to get to scale. Now, if there's a hugely valuable market, but it's going to take 20 years and $1 trillion to actually become the enduring market leader, guess what? You're never going to be able to get investors to put the money in to do that. You need things where your distribution model will allow you to get to critical scale faster. And that is usually going to take place because of virality, because each new user brings in more users, or because you're able to leverage existing distribution networks. And sometimes you have the both of them. So for example, Dropbox is a company which which represents all the different kinds of distribution. So it has virality, organic virality, because as you share files back and forth, people become exposed to Dropbox. It's like the traditional virality of email from Hotmail way back when, for those of you who are old enough to remember that. There's also incentivized virality, in the sense that if you refer someone to Dropbox, then you get more free storage yourself. And so that creates an incentive to refer others, and that increases the virality over and above the organic virality. And then finally, Dropbox does distribution deals with computer makers, with the various handset manufacturers, and so on and so forth, to get Dropbox preloaded and pre-installed and make it possible for people to get Dropbox more easily. There you're riding on top of this existing network. So the combination of these things allows you to build a very powerful distribution strategy, which again is important for getting to that critical mass. So when you're thinking about your own company, if you're trying to figure out, should I blitzscale, first go through and say, do these essential elements exist? Is this a winner take most market? Can I come up with a scalable distribution model, especially one that is differentiated? Right? Sometimes you'll hear people mistakenly saying blitzscaling is about raising a lot of money and running advertisements. Well, advertising is scalable. You can buy a lot of ads, but it's not differentiated, right? Anyone with a checkbook can do it. And maybe you're better at picking out great ads, like Apple was great at advertising famously, the 1984 ad, or the Think Different ad, the I'm a Mac ad. But even then, that's not what made Apple successful. It's just one of many tools. So let us continue. Wow, so many questions. I don't know how I'm going to manage to get to them all. So very quickly, the blitzscaling then takes place in stages. So as your company grows, it goes through an evolution, and it becomes basically resembles different kinds of human organizational units. So stage one, it's based on the number of employees. You have a family, which is less than 10 employees. And it's like a family because everyone knows each other. Everyone sees each other on a daily basis. They're all in one place. And so you have this very informal way of going about things. I'm pretty sure for most of you, if you have your family, you don't have a monthly board meeting or an annual report or anything like that. You just, do stuff. The next stage up is the tribe stage. That's like 10 to 100 people. And there, things are still pretty informal, but you kind of know who's in charge, right? There's certain people who are in charge of various things. This person's the head of hunting. This person's the head of gathering. This person's the medicine man or woman, right? These are things that happen. You start to get more differentiation, more permanent roles. Stage three, your village, you got 100 plus people, and now you start seeing formality starting to come in. There's somebody who is the head man or head woman of the village, and they may have some officers and things like that. You may have a village constable, right? You start having this differentiation and formal roles and structure. This is actually one of the difficult transitions, going from tribe to village, because you're going from an informal culture to a formal culture. So it's sort of like this, you hit a tipping point where all of a sudden you need to start thinking formally. And this can be difficult for early employees who are used to the old way of doing things. This is something that's difficult. These are things and transitions that are difficult to avoid. But if you know about them in advance, it makes it easier for you to actually navigate them. Going beyond that, you go up to a city where now you have a lot of structure. You have a mayor, you have a police chief, you have all these different folks, a district attorney. You go up to the nation level, and really, if you're the leader of a company at that stage, you can't rely on retail politics, right? You can't, as the president, shake enough hands to really convey your vision. You have to become the master of the broadcast medium, of the State of the Union, of all these different things that are going to convey your vision to people in a scalable way. And so it's important to know that as your company grows, each of these stages is a big shift, right? The things, the processes, the way you did things before may no longer work when you get to a new stage of scale. And knowing that allows you to anticipate it and be flexible instead of trying and saying, well, it's not working, but if we just do more of what we were doing before, I'm sure it will work. No, you have to be different. And one of the parts of different, and this is one of the toughest things to tell people, and one of the biggest parts of different is that the people who are leading the company may change. It may not be you, it may be other members of the management team, but it's not unusual for a company to switch the roles and switch the members of the management team by up to 50% for each stage. And it's because some people are really good at one stage or another. It's very difficult to be good at all of them. And this is one of the toughest conversations you may have with people. But if you are able to be upfront about it, if you're able to tell people, listen, this is how things change over time. And one of the things is, listen, we want you to be a part of the company, but your role may change over time based on what you're really good at. And at all times, hopefully your role is increasing. You are getting more responsibility, more power. But the person who runs an engineering team when there's 20 people may not be the person who's running the entire engineering team of a 50,000 person company. But that person who ran the engineering team at 20 people, who oversaw 3 other engineers, at the nation stage may be overseeing a team of 500 engineers, even if they're not the VP of engineering or CTO of the company. So I mentioned that there are going to be key transitions that you go through. So the key transitions are all listed here. They're all available in the book as well. I will give you guys a chance to go ahead and, wow, these are so many great discussions. I'll give you guys a chance to take a look at these. And in the interest of time, I'll explain one of them. So go ahead and pick which one. Vote in the chat room. Pick which one you'd like me to explain. All right, so we get into Pirates and Navy, single to multi, single focus, that's 2. Dialect to broadcasting, single multi, that's 3. Journalist to specialist, broadside, that's 2. Pirate to Navy, that's 2. Small teams to large teams, single focus. Please. Small teams to large teams, single to multi. So it's interesting. Different organizations do different things. It looks to me like, wow, there's so many. But I feel like single to multi has sort of come out on top. Although, well, there's a late surge of inspiration to data. Oh my goodness, pirate! Lots of people love pirates. All right, I got to call a halt to it. We've got so many. I am going to reward the late. So somebody asked, Victor asks, what's the most difficult to execute? Oh, that's such a good question. All right, so let me talk about what's the most difficult to execute, and that will shape it. And that was brilliant, right? He didn't stick by the rules. He came up with a different question. So I would say that the most difficult to execute is probably the shift from contributors to managers to executives. And I'll explain why. So at the earliest stages, everyone is a contributor. Everyone is getting work done. And as the company grows, then you start to have managers. And the job of a manager is not to do the work themselves, although they may have work that they're doing. It's that they're going to try to get the best out of their people. And most people can manage the transition from contributors to managers. And that's a reason, and that's largely because all of us who've ever worked in an organization have had a manager. And many of us probably had a good manager at some point in time. And so we have a role model that we can turn to and think about when we do this. And it's somebody we interacted with daily. So we just think of ourselves and say, okay, I'm going to shift to the other side of the desk. Now, the shift to executives is different. An executive is a manager of managers. So their job is not to figure out how to get people to do certain things. Their job is to figure out how to get the organization to perform as well as possible. And for those of us who are primarily individual contributors, we haven't gotten a chance to really work directly with executives and see what they do on a day-to-day basis. And so we often struggle as we're trying to upgrade ourselves from manager to executive to understand that the job and role of an executive is fundamentally different than the role of a manager. And because of this contributes to a second issue, which is in a company that's growing, and especially a lot of times startups have a lot of young folks who are there, who are not experienced. If you want to bring in an executive, and it's so difficult to transition from being a manager to executive without a role model, then a lot of times you have to bring in these executives from the outside. And bringing in the executive out from the outside presents its own set of challenges. I think that we've all seen probably examples of it going badly. And the reason it generally goes badly is one of two reasons. The first is you bring in an executive from a big company who doesn't know how to operate in a startup environment, right? As we saw, there are these different stages and people are good at different stages. Well, if you're a village stage company, you hire a nation stage executive, it's not like, oh yeah, they're just better. No, they're not a good fit. Their ability to get things done is not going to be there. An executive who's used to eating in an executive dining room and having a car that drives him or her around is not going to be a good fit for a startup company. But then the second is, are they going to be willing to actually listen when they get there? And are the people going to be willing to listen to them? You need executives who are willing to listen and accept that the company got to where it was because people were good at what they did. And they should have an open mind when they come in to what the company has done before to figure out, okay, what can I do to add to this? What can I do to build on this success? Instead of thinking, I'm the new sheriff in town, now we're going to do things my way. But the other side of it is, are the people who are existing at the company already going to accept that executive? And so the technique that works really well, and this is what we write about in the book, it's something that my friend John Lilly did when he was CEO of Mozilla, and it's something that Facebook does, is you bring in one of these executives from the outside and you bring them in at a level below where you intend them to be. And the reason is, the fact that they're coming in and willing to accept a lower level appointment, A, demonstrates that they really care about what the company is doing and that they believe in themselves. And B, it allows them to come in, demonstrate why they're so valuable. And now all of a sudden, when they're elevated to executive and they're put in charge of things, people are like, well, of course, absolutely. And the example that we use in the book is Mike Schrepfer, also known as Schrep, very famous executive in Silicon Valley. John brought him into Mozilla, and he started off as a manager of engineering and then quickly became the person in charge of engineering. And he brought him in at a lower level because he wanted him to prove himself. And Mozilla was a company with a very consensus-driven culture, very flat hierarchy. So this was a good way of actually getting Schrep in, and became apparent, hey, this guy should be in charge. The same thing happened when he went to Facebook. And he went to Facebook as a director of engineering. He began working on things, and pretty soon everyone's just like, why isn't this guy in charge? He should be a VP of engineering. So contributors to managers and executives is a very difficult transition to manage because we typically don't have enough experience with it, because we're bringing in executives from the outside, but there are ways around it if you are looking for the right things. And Ajit mentions, Cloudflare's founders express the same philosophy for building their board of directors. That may very well be true, and I'm always a fan of Cloudflare because they are from my alma mater, Harvard Business School. So next, there are the counterintuitive rules of blitzscaling. So because of the fact that blitzscaling is so counterintuitive, it means that you have to do things that are very different than what you would learn at Harvard Business School. So again, take a look at these counterintuitive rules, pick the one that you like the best, put it in the chat room, and I will explain that one. And again, all of these are contained in the book, so you'll ultimately be able to get all of them. Bad management, that's always a good one. By the way, you'll notice that we sort of pick these titles a la Blitz, BuzzFeed headlines. It's designed specifically to be thought-provoking and be clickbaity. So bad management, fires burn, bad management, ignore your customers, things that don't scale, fires burn, ignore your customers, raise too much money, ignore your customers, fires burn is on Reed's podcast. Many of these are on Reed's podcast. We have done a number of them there. Ignore your customers, let fires burn, ignore, launch a product that embarrasses, fires burn, embrace costs, do things that don't scale, do things that don't scale, let fires burn. Which one do I see the most? Okay. Again, somebody who's cleverly seen the Jonathan says, which one do you see the most often? So let me talk about let fires burn, which is, again, as somebody mentioned, covered in one of Reed's podcasts, but it is sort of the meta rule of blitzscaling. So let fires burn is basically a metaphor. You think about the age of sail, wooden ships with sails and cannons and things like that. And you're in a fight for your life, and you're the captain of the ship. And because the ships are made out of wood, one of the biggest issues is they catch fire. And so as you look around you, you see fires everywhere. That's your life as an entrepreneur. There's never enough time to do everything. There's always stuff going wrong. And letting fires burn means you have to accept that you cannot put out all the fires. If you try to put out all the fires, all that's going to happen is you're going to burn yourself out. So you have to be intelligent about which fires to deal with at any given time. And all of these counterintuitive rules of blitzscaling can be seen as a special case of letting fires burn. Now, what does letting a fire burn mean? What it basically means is taking on some sort of debt. You've probably heard of the concept of technical debt, right? In software engineering, we take on technical debt when we hack things to get things done. We take shortcuts, but we know we're going to pay later on. There's management debt, things like tolerating bad management. And so it all is a question of, okay, which of these things can I allow to burn? I'm going to incur some sort of cost. I'm going to have to pay it off later on. But then what do I invest that time in, or what do I invest that resource in, and what return do I get on that investment? Because if I can take resources away from a fire that I can allow to burn and put them into something else, a fire that is essential or an opportunity, and I can get a return that's much greater than the costs of fixing the problem later on, then that may be the right thing to do. And in the case of letting fires burn, I describe it as, well, here's one fire. It's burning the hammocks that the sailors sleep on. You know what? If we get through this battle, if they have to sleep on the floor, that's okay. We'll deal with that. That fire over there, it's by our gunpowder room. That's not good. Someone go put that out right away. And so figuring out what you need to prioritize is essential. You are the ER doctor trying to figure out, okay, which patients do we need to treat right away and which patients can we keep here for a little while? And letting fires burn, that is figuring out which fires to let burn, figuring out how to prioritize the fires, figuring out how to triage. That is one of the most important things you do as the leader. You have to make sure that people are always focused on the fires that are most important. They're going to kill you, or the opportunities that are going to be the breakthroughs. And focus is very essential early on. And again, there's a single focus to multi-threaded. There's a whole discussion of that later on. All right, let's continue because I want to have a little time at the end. Responsible blitzscaling. This is why there was the question earlier about blitzscaling things like responses to global warming and whatnot. So blitzscaling is something that only happens because you exist within an infrastructure, societal infrastructure that allows you to do things. So you should not harm that infrastructure in the process, as Theranos did, as we discussed. In addition, if you're responsible about self-regulation, that reduces the chance that the government's going to come in later and produce punitive regulation. You may have noticed that there's all these lawsuits underway to break up Facebook. Do you think those lawsuits would be underway if Facebook hadn't caused this breakdown in the fabric of society? Unlikely. People want to punish those who have been irresponsible. The fact is, people believe Facebook was irresponsible, and that is why they're doing this. Now, how do you assess that societal risk? You look through the different lenses. You ask yourself, how much uncertainty is there? What's the severity? What's the scale? And most importantly, what's the fallout? So anything that is systemic, like, oh, I'm going to break democracy, you got to be a lot more responsible and devote a lot more attention to fixing the problem. Versus something that is a known issue, that is relatively mild, that is narrow in scale and is isolated in fallout. Guess what? That's a fire that you can probably allow to burn because there are other things out there that are unknown, severe, broad, and systemic that you really need to worry about first. So responsible blitzscaling is something that I hope all of you, again, we haven't charged you for this event, so I hope that all of you take that away and deploy these tools responsibly. Now, if you figure out that there's a risk, you can decide, do you take decisive action now? Do you take short-term action now and then permanent action later on? Or do you just note the problem now and commit to action later? There's nuances, right? There's differences between let the fire burn and put out the fire. There's like, oh, well, let me throw a little water on now and hopefully it's just smoldering and then I'll really put it out later on. I'll shovel some dirt on it later on, right? There's different nuances. And the fundamental thing is to just ask yourself, what things, if I don't fix them now, will be impossible to fix at scale, right? Not difficult, but impossible, because you want to focus on the biggest issues. Marty notes, if you attack a system, it will defend itself. And there's people lobbying for talking about ignoring customers. So I hear you on that. So I'm going to just do a quick recap. Blitzscaling is the pursuit of growth by prioritizing speed over efficiency in the sake of uncertainty. You do it to win a winner-take-most market, a Ricky Bobby market. You can identify those markets by looking at the the network effects and the land grab, and then you're looking for an opportunity where you have that scalable distribution. You, of course, still need to have a big market, high gross margins, product market fit, and the ability to scale. Your company is going to go through multiple stages as it grows, and you can manage those stages by going through and managing the key transitions and following the counterintuitive rules of blitzscaling. And as you go along, of course, please be responsible. Now, if you enjoyed this talk, of course, you can follow me on Twitter at Chris Ye. You can go to chrisye.com and find my content there. That's a good clearinghouse. Blitzscaling Ventures, Lloyd mentioned at the very beginning, if you happen to be a multi-millionaire, I would love to hear from you. We've got a first close that's going on, a lot of great investors in, but always great to have more. And Global Scaling Academy is the organization that I co-founded that takes these ideas and puts them into the form of community and classes. So if you're interested, if you thought this was really helpful, check out Global Scaling Academy as well. So with that, I think I will open it up to questions. And also, Lloyd, if they have any comments as well, please feel free to jump in at this time.
It was fantastic. I learned a ton, and like taking notes. And I usually what I do is I edit all the videos, and it's not scalable at our stage. Anyway, I sit at night and I listen to the video and then I edit it up. For companies that are not the traditional venture-backed route, right? What do you recommend for them if they want to blitzscale, or like it's completely out of the question? Like, how do they think about it? You must come across founders like that.
Absolutely. So the thing is, people are always focused on venture capital, and that's fine. I'm technically a venture capitalist as well, so I don't mind that. But it's really a thing that blitzscaling is relative. So if you're in an industry that doesn't attract venture capital, or you're in a business that isn't funded by outsiders, then the question is, well, that's okay. Can you still find other ways to move faster than the competition? Because at the end of the day, it's all about speed. It's not about spending money. Spending money is a means to the end of increased speed. And if you don't have to spend money to get that to go faster, so much the better, right? There's no law that says, you know what, I'm going to raise $10 million and I'm going to take $5 million and set it on fire. Now I prioritize speed, right? No, you just set money on fire. Why did you do that? So take a look at your situation. And if in fact you're not competing against other venture-backed competitors, then no problem, right? Now, if you are in a situation where you have a bunch of venture-backed competitors and you're not venture-backed, you better have something that is really a ton better, because it's really hard to compete if you have no money and somebody else has $50 million. The final thought there is, you may be that you go through and you evaluate your business and you're like, you know what, this isn't a blitzscaling opportunity. It's not truly a Ricky Bobby market. That's okay. You can still use some of the techniques of blitzscaling as a way to increase your speed. So when there's times when you're like, I really need to move faster, like, oh yeah, I remember that talk. What were some of the things that people did in blitzscaling to move faster? And you could deploy those techniques to move faster, even if you don't focus on doing a complete blitzscaling job.
When you're looking at industries where there's no winner take all, right? So you talk about this, like, move faster than the competition, blitzscale, but you look at an industry like accounting, for example, there's like KPMG, PwC, Deloitte, EY, and then like dozens and dozens of people. How do you think about industries where they might not be a winner take all?
Absolutely. So there, what you do is you say, well, what can I do that does not necessarily sacrifice efficiency, but still gives me the opportunity to be to still win the competition. So if you think about accounting, for example, you might say, well, is there a way that I can build in more virality or to tap into existing networks of distribution so I can grow faster? I'm not going to do it in a way that costs me money hand over fist. I'm not going to give away my accounting services for free when it costs me money to deliver them. But there may be things like, well, what if we work together with this, a conference like Traction, and we have a special offer, which is a half-hour free consultation. And this allows us to get in front of more people. There's ways you can borrow little bits and pieces of blitzscaling without necessarily adopting the whole thing. Again, the point of blitzscaling is not to spend money or to sacrifice efficiency. It's to move faster. And if you can find a way to move faster by taking some, but not all of the framework, that is perfectly okay with me.
Have you seen any scenarios, business models where blitzscaling shouldn't be the strategy? And I like the one before, because you're saying, yeah, you can adopt models of it and then get there. But yeah, what are some ways where you don't Blitzscale?
So my favorite example from the book, I loved it because it was just this remarkable coincidence. So there are two companies, both of them considered among the best in the world, two businesses that were started in the same year. One of them was Amazon, but also started in the exact same year was the French Laundry, very much in the news recently because apparently it's so good that politicians can't help themselves from going there even during a pandemic. But it's been considered the best restaurant in the world for a long time. The French Laundry serves 60 people a day. That's it, right? They cannot actually scale that. The whole thing is this remarkable experience, and Thomas Keller has not scaled it. Now, he has done various things like open up outposts in Las Vegas, have cookbooks and other things like that, but the core restaurant business, that is not something that is Blitz scalable. And that's okay, because it's still one of the world's greatest businesses.
Is product market fit mandatory or not?
You have to achieve product market fit. Now, there are times when you may start Blitzscaling without it, with the notion that you're going to be able to find it. But rest assured, if you don't find that product market fit at some point in time, you are going to fail, just like the folks at Groupon ultimately failed.
Thanks so much, Chris.
Thank you so much, Lloyd, and thank you, everyone. This has been a fantastic audience. You can tell I enjoyed myself. I rarely get this much time to really go through and expand, so I really had a good time, and I hope you guys did too.
I need some traction.